Arvind Sanger, Managing Partner, Geosphere Capital, joining us from New York. Arvind, it's great that you could take out the time to speak with us today. Uh, while the Fed has indicated that there are going to be 2 more rate hikes, and we were just speaking with Michael Every a little while back, who said, it's still not a foregone conclusion that 2 rate hikes are in the offing. It's just the way the dot plot has been laid out that the market is interpreting 2 rate hikes. But one would imagine that, given the economic backdrop in the US with growth picking up, with inflation having upside risks, and unemployment being at record lows, that, the stage is really set for the Fed to pretty much press the pedal and get a bit more hawkish on their rate stance. What did you take away from yesterday's rate decision?
Yeah, I mean, it's clear that Fed is getting more and more confident in the economy. And like you said, the inflation numbers, are not alarming, but they're, strong enough that the Fed doesn't have to be hesitant. And so I think the Fed wants to get to a more normal level. Clearly, we are in, levels of interest rates which are still very accommodative in terms of historical, compared to historical averages. So therefore, I think the Fed is slightly more showing more confidence, which obviously is more hawkish, because now we're talking about potentially 2 more rate hikes this year, which is higher than what was in their official dot plot. Although I think the consensus was kind of swinging between 3 or 4. This may move it in that direction. So I think all of that just means the economy is doing fine, and the Fed is trying to normalize the rate structure, which shouldn't be a big deal, but clearly we've seen some blowups in emerging markets. So I don't think it's something that is inconsequential when we look at global markets. It may not be that consequential for the US market in and of itself, but it has consequences for other markets.
Yeah. So, Arvind, I mean, what do you believe could be the consequence? And do you think this could very well stall the rally for US equities, which have been soaring to fresh highs on a daily basis? Even yesterday, you saw them peg back a little bit. 2 more hikes, and if that be the case with the hawkish commentary, do you think that's going to spell bad news for equities?
I don't think it's bad news for everybody. I think part of the reason that they're more confident about doing this is because the U.S. markets the U.S. economy seems to be strong, like you mentioned. Unemployment is at record lows. Earnings growth seems to be good, and the tax cuts and frankly the deficit are providing fuel to the economy, and therefore for those reasons, I think the U.S. economy is less vulnerable to that. I think there are other risks to the U.S. economy to the extent that NAFTA or any other trade-related issues break out, and that causes concerns on that front, and that affects some of the growth assumptions underlying expectations. But barring that kind of nasty negative surprise, which is definitely possible, but barring that, I don't think the rate rise by itself is going to kill the economy. But I think, as we've seen with a few emerging markets, whether it's Turkey or it's Argentina or it's Brazil, that the impact on some emerging markets, their currencies and their markets, has proved to be much more severe. So I think one of the risks remain spillover into other markets, and does that feed back at some point into the U.S. economy in terms of slowing global growth. So I think that's the bigger risk rather than the U.S. market itself or the U.S. economy itself keeling under the weight of higher interest rates.
Okay. Having said that, Arvind, if the risk is, one which is EM negative, then what would the position be like for emerging markets going forward? And particularly, while Indian macros look okay, do you think that India will also see, part of the withdrawal that may happen from across the asset class, if that were the case?
Well, India has had 2 things happen. India has had its own inflows slow down. And clearly, with the severe beating that some of mid-cap indices or small-cap indices have taken, you've seen some withdrawals out of some of those asset classes. So India is having its own challenges, and those are not going to go away. And if you do get foreign investors getting a little bit less enthusiastic about investing emerging markets, including India, then that creates another headwind. So I think there are a couple of macro risks, but on the other hand, the bottom-up story in India is getting better. And so unfortunately, we are in one of these situations where the macro risks are increasing while the bottom line of the companies and the earnings outlook for many sectors is improving. And the question is which wins out. And I think what ends up happening is that we are stuck in this trading range, especially when you throw in the uncertainty around the political risks around the election next year. And then you throw in risks that oil prices have taken a bit of a breather here, coming back from $80 to $76. But I don't think that by any stretch of imagination, we can assume that the worst in oil prices is behind us. So if there is upward movement in oil prices back towards 80 and beyond that, we think it could go to 90 plus, then that's another potential headwind for India and many other emerging markets, which are import dependent. So I think those are things that are not going to go away. And therefore, I think, we felt all along this year is going to be a year where one has to be much more careful about individual stock picking and the macro side of the equation. The easy money that was made last year is certainly not going to be, anywhere near that kind of optimistic scenario for the market.
An easier to deal with, and not everything is moving higher. That market has already shown it to us that how selected stocks are taking this market high. My question is again, I'm going back to EMs and impact of that on India. As you mentioned, we have seen some problems emerging in countries like Argentina, Turkey. Italy has its own problem to do. Now, I understand that, you cannot have a simple equation that if dollar appreciates, it would have, impact on EMs, and then the crisis would loom large on the currencies. But this is a hypothetical question. If interest rates continue to go higher, and Fed clearly mentioned that despite hike in interest rate, their stance is still, or this is still an accommodative stance, and they want to move out of it. If dollar appreciates, and I'm getting into mathematics over here, if dollar index say move above 95, 98 level, do you think this would just aggravate the currency crisis in some of the EMs, and which would have cascading impact on countries like India also, because we are also not very far away from all-time low currency level compared to US?
Well, I think that, let's look at it in history. In history, Fed raising interest rates has not necessarily been always bad for emerging markets. If it's coming against a backdrop of good global growth, then everybody has rising interest rates in the face of rising growth. That would be in a normal environment. But what makes this environment unusual is we had for a long period of time record low interest rates and record accommodative policy. And what we are now finding, there's that old saying, when the tide goes out, we find out who's been swimming naked. And I think what you're seeing in some of the emerging markets that have had the blow-ups in either their currency or their markets, which in India is not part of. India's currency has weakened moderately, but if you look at the Indian rupee over 1, 3, 5 year period, it's below historical its level of correction. So I think that I don't see too much in concern so far in terms of the Indian rupee, and I think some of the emerging markets that have got into trouble have made mistakes during the period of super low interest rates. I don't think India has had the same kind of policy errors, and therefore I don't see India as much at risk. I think India's risks lie more if oil continues to rise too much. That would be a bigger risk to me for the Indian market than purely Fed policy normalizing, because the RBI is also embarked on a rate increase path, and that while it's a bit of a headwind for the economy, I think the Indian economy can handle it if the earnings growth and the demand for a variety of goods and services is improving, which obviously there's a lot of pent-up potential for demand to grow after having lagged because of demonetization and because of GST. So I think there are catalysts for Indian growth to be there, but clearly the headwinds of oil, Fed interest rates, and the political risk are three factors which are probably going to make it, a challenging year. So I don't want to sugarcoat it. But at the same time, I don't think India is in a as dire a state as some of the other emerging markets have been.
Arvind, it's great to hear that. It's just that, you're still part of the EM contingent. So if something goes wrong in emerging markets, as part of the MSCI EM index, India can also be a falling culprit to some outflows if that were to happen in the wake of, like you said, rising interest rates in the US. But, back home, we're celebrating Infosys turning 25 on the exchanges. It's been 25 years since the bellwether has been listed and has created enormous wealth for investors from all classes. You've been in the markets for as long as you have. How do you look at the Infosys story? And do you think that, within the believers as well as the non-believers in the markets today, given the leadership transition that Infosys is undergoing, that, opinion is still divided on Infy's future? It's been a great 25 years, perhaps, great 20 years, and maybe the last 5 years have not been so great. But even so, does the future look bright?
Well, I think Infosys, like a number of other Indian IT companies, is kind of, going through, I don't know if it's version 2.0 or version 3.0, which way to think about it, because they were founded during the time of the, scare about Y2K, and then they moved to this whole, outsourcing and taking advantage of, being the tech support function and doing a lot of things for many industries, but particularly for the, for the financial sector. But I think this phase is really about transforming from their somewhat lower value-added service offering to higher value-added, I guess what is commonly referred to as digital. And I think, all of these companies are seized of the opportunity and seized of the risks and seized of the challenges. So I think that Infosys, along with obviously TCS as the largest player today, and many of the other IT service companies are adapting to that. I think the growth challenges will be different. I think the easy growth that the Infosys and other IT companies were able to enjoy in the 20 years prior to the last 5 are not going to be, recurring. But I think that doesn't mean that they can't adapt and find a new way to, to prosper. And I think that's really where, Infosys and the other Indian IT companies are focused. And, we're optimistic that there will be opportunities, but it will be, it'll be a little more measured growth. And so it'll be a different next 25 than the last 25 have been.
Indeed. Arvind, thanks so much for staying up late and managing to chat with us, and not just the Fed, but Infosys. And I would have, had it not been that late in New York, I would have asked you to stay up a little longer and catch our special coverage on Infosys as it turns 25 as a listed entity today. And we're going to have the voices that matter.